Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, and more, including smaller deals that you can do without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Matt Bodnar, a Forbes 30 Under 30 alumni and partner in multiple Inc. fastest growing companies, is a private equity sponsor who has scaled businesses across multiple industries. Bodnar is the founder and managing partner of Eidolon Capital, and he is a major investor and chairman of Ozark River Manufacturing, ProRack Systems, Fresh Technology Inc., and Highland Industrial Staffing. He is also the creator and host of the Science of Success podcast with more than 5 million downloads. Bodnar previously worked as a consultant in Nanjing, China, and spent several years at Goldman Sachs in New York. Matt, welcome to the podcast.
Corey, thank you so much for having me. I'm super excited to be here and I look forward to jumping in.
Yeah. So listen, Matt, before we get into, obviously the bio sets forth a great background. We're going to talk about PE, investment, other deals, your experience and all that kind of stuff. But before we get there, I want to take you back to when you were a little kid growing up, maybe 10, 12 years old. What did you want to be? Because I'm guessing it's likely a PE sponsor wasn't it back then, but you tell me.
You know, honestly, when I was probably 10 or 12, I really wanted to be in the CIA. Like I really wanted to be a spy. And I don't know, I was never into sports as a kid, partially I think because I had zero athletic talent. Okay. But also I always just thought army, military, spy, like I just thought that was cooler than sports for whatever reason. So I wanted to be a CIA officer. Obviously didn't go down that road, but I still feel like I would have been good at that. And I feel like it would have been, if nothing else interesting, though, probably a different lifestyle than being an investor and having a family and all that kind of stuff.
Yeah, that's for sure. One other question, looking back, what was your first deal of any type you can remember? It could be something smaller when you were young or something early in your career, whatever comes to mind.
Yeah, I mean, the first real deal, deal that I did, quote unquote, was an acquisition. Acquisition even probably overkill really to describe it. But the first deal I kind of bumbled into was IT services business that I bought in 2011, which is when I just come back to Nashville, which is where I'm from, and from being up in New York at Goldman. And I basically met the founder of the business, kind of a family friend, and he was classic. If you've ever read E-Myth, sort of entrepreneur, manager, technician, classic technician, highly technical, really limited management, social skills, that kind of stuff. And the business was doing about $1 million of revenue. So really small and basically breaking even, kind of couldn't make payroll, mostly because they just were really, really bad at collecting their accounts receivable and their books were generally a mess. And so I basically started just helping them out because they were struggling. And then we kind of struck a deal that was like, hey, I'd like to basically get some ownership in this business. And, using the fancy term, it was effectively a seller financed buy-in or, an equity earn-in into the deal, which started out at about 40%, eventually ended up at about 65% of the company. But I really just bumbled into it, helping somebody out whose business was treading water, kind of stuck in the mud. And I learned a lot in the first 6 to 8 months, really practically one of the most important lessons I think that I still carry with me to this day, which was the importance of receivables and the importance of the difference between revenue and cash, right? Because this business was selling Aloha point of sale terminals, to give you a sense. So for restaurants and stuff like that. And these things, an installation would be $40,000, $50,000, but you'd have 20 or 30 grand of hard costs. Like you're going and buying from Aloha, $30,000 worth of hardware, and you're going and putting in somebody's restaurant, and then you never get paid that starts to become a problem really fast. And so, I mean, my early days were like banging on people's doors and threatening to shut people's systems down and, getting yelled at and kicked out of restaurants and all kinds of stuff. But I learned to become extremely vigilant about paying attention to receivable collections and cash, and much to the chagrin of most of the management teams I interact with now, because they know in our weekly or monthly report that I'm going to page through and grill them on any receivable that, moves out of probably the 60-day band from an aging standpoint.
Yeah. It's interesting because that's a weak spot for a lot of companies. I've, whatever reason, been, we're very, very fortunate. We have very few receivables issues, even though, I'm in new clients, we take retainers, but ongoingly we don't. But even the few that we have, I mean, out of, a couple hundred clients in a year, maybe we got one or two, they drive me crazy for whatever reason, right? And I'm like,
yep.
It's me like, damn, why don't, we got to be on top of these. And they're like, yeah, Corey, we're doing really well. Like our, late receivables, it's so tiny. But yeah, that's such an important area. So I'm curious. So you come back, let's talk a little bit about this, transition, right, into your, sort of backing into your first deal here. So you come back home from Goldman Sachs. Like, first of all, give people a little color into what you were doing at Goldman Sachs. And then, like, what was your intention when you were coming home? And like, it obviously wasn't necessarily, you didn't come home to target to be involved in this business, it sounds like, right?
Yeah.
So what was your intention? And then how did you sort of end up there?
Yeah. So at Goldman, I actually wasn't doing sort of traditional PE stuff. So I was in interest rate derivatives desk in the sales and trading side of the house. So, I mean, I still learned a tremendous amount about finance, but I wasn't, crunching models 18 hours a day, though we were working super long hours, but we were more market facing. But rates, specifically in interest rate derivatives, I think actually was really beneficial from thinking about not only debt financing broadly, but especially about structure, because rates are a highly structured product. And when I'm going through training and stuff, there's like all these flow charts and arrows and these cash flows, and this is floating and this is swapped and this is capped at this and that. And like, I think that actually really helped me conceptualize a lot of more creative deal structures like seller notes and how to make really interesting earnouts and those kinds of things. And so those structuring lessons really stuck with me. But you're right. When I came back, I took, for starters, a massive pay cut. Even I wasn't at Goldman that long. I was only there for 2 or 3 years, but I still had, a pretty sizable down trade when I moved back to Nashville. And I originally came back, my father, brother in the restaurant business. So again, sort of connectivity there to the point of sale company. And they have a number of different restaurants. I came back to kind of help them out. They sort of sold me on, hey, move back to Nashville, get involved in the restaurant world. And I'm still a board member of a couple businesses that they're really active in, but focus pretty much all of my efforts on the PE space and sort of building a portfolio of operating businesses today. But that's originally the impetus for why I came back to Nashville, was kind of, hey, I'll jump into this pool, sort of see what happens. And, I remember I moved back to Nashville. The company was actually headquartered in Birmingham, Alabama. So I was traveling there all the time. My wife had just moved. We were engaged at the time, not even married. She had moved from New York down to Nashville. She didn't even have a driver's license when she first came down. So she was, she was taking the bus, and like, this is before Uber, and so she was like not having a great time getting settled. I was gone like 3 or 4 days a week in Birmingham trying to turn this IT company around. So it was, growing pains, but we got through it, and I learned a lot of lessons, and it was a fun time.
Love it. And then you eventually sold that company, right?
Well, so it started out as a point of sale dealership. Yeah. And then we expanded into being a managed service provider. Yes. And we eventually divested the POS business entirely. Okay. And so got out of the original business we were in, but kept the MSP. Yes. And then we also did a couple kind of small, originally an investment, then eventually an acquisition of a software company, and built up basically a software platform that became bigger than the MSP business. So today I actually still have, and my general thesis is oriented towards longer term holds. And so I still have both of those businesses. They're technically under one umbrella, but today really the software company is actually the mothership, and the IT business is still a great company. It's an awesome little business, but it's sort of technically kind of a subsidiary of the SaaS company today.
Got it. And then you divested the original. That's interesting. So let's talk about that, because there's several deals in that, right? There's the divestiture of a division, which is always interesting when you're divesting what started the company, right? And then I want to definitely spend a bunch of time on your philosophy, which I know is very different than a lot of PE firms, right? The concept, I mean, obviously I don't want to put everyone in the same bucket. It's not, they're not all the same, but generally the concept of buy and hold in PE don't go together, at least for not more than, 5 or 7 years or something. So, but before we go there, I want to talk about this divestiture, like even, so obviously it sounds like you got more equity over time, in the company.
That was part of it too.
Yeah. And so anything, obviously nothing confidential, but I always like to, one of the things whether it's our listeners, my clients, people in my circle, entrepreneurs, in fact, the talk you and I was speaking before this about where I was traveling when you and I had our pre-call and I was heading to Singapore. And the talk I did in Singapore for Entrepreneurs Organization was on the theme of a deal maker's mindset, right? And on the concept that my premise was that any business challenge, frustration, issue, right, or opportunity, untaken advantage of opportunity can be solved with a deal. Not that it should be, right? It's one of the tools in the toolbox. But if you're having trouble hiring, you can recruit, you can pay recruiters, you can pay bonus, you can put ads online, but you could also acquire a company for the talent or do an acqui-hire, or whatever, right?
Yep.
So that's the concept. So, and the sort of joke, the little thing around it was like, they say there's an app for that. My thing was there's a deal for that, right?
I like that.
Yeah, there's a deal for that, right? So, but it starts with a shift in mindset. And you mentioned the E-Myth, which is a big Bible around, one of the real Bibles around the Entrepreneurs Organization, the book everybody's read. And, this whole concept of, the employee versus entrepreneur mindset and, creating a business that runs without you, all that kind of stuff. But there's another mindset shift to a deal maker. So you're a guy who actually wasn't on that side of the deal thing at Goldman Sachs. You come in, you take you have a minority position in this company, turns into a majority position, right? That's a deal. You divest,
the divestiture.
That's what you do. So I want to, hear a little bit about like what had you, was it learning around the way? Did you naturally have this way you looked at things in terms of doing deals? And I'm sure that's part of what led you into the PE space. Like what was the mind, shift? Or
yeah, there's a couple elements there. So, I mean, I think one, I love the framework, the deal maker's mindset, and the deal can solve any problem. It may not be the optimal tool, but I think it can. And that divestiture is a perfect example of that. So that business partner that I mentioned, or the founder of the company, really was a very cantankerous kind of technician, liked the technical piece of the business, liked the point of sale business. And, looking out into the future, when you go to a restaurant today or a coffee shop or whatever, 9 out of 10 times they have an iPad and not a giant point of sale terminal. Now there's still some use cases for that, but it used to be ubiquitous. Anytime anybody opened, they had to buy the big whole POS package. And we saw the writing on the wall that, hey, this business is probably not going to continue to be what it is today, and wanted to get out of it. And it was very fortuitous because the other business partner basically really liked that business. And so we said, hey, why don't we sort of valued everything up and said, hey, why don't we give you 100% of that business in exchange for, the equivalent value of the rest of the business. And so swapped that. And then he went full-time, kind of focused on that company, had a residual equity stake that we eventually bought out. And around the same time we bought that out, coming back to sort of the second piece of this, is I brought in a couple, maybe 18, 24, a year or two later, brought in somebody to be president and CEO of the company. And I stepped out of the operating role. And that was really helpful for me to say, hey, now I want to be more of an investor, because I'm okay at being an operator. I don't think I'm great at it. I can do it, but it's not my zone of genius. It's not where I want to play, and it's not where I want to be. And so that was, we used the deal to kind of get rid of a problem partner and a problem business unit in one fell swoop, which was amazing. And then eventually that paved the way for bringing in a new management team that helped me scale out of the operation. And I have at some point relatively early in my career, it dawned on me that I should probably read some Warren Buffett, right? I mean, if you study investing, right? I mean, he's arguably the most successful investor of all time, or certainly one of them. And I started reading all of his stuff, and I probably took it too seriously and just actually listened to the stuff he was saying. And so, what does he talk about, right? Just buying businesses, like holding them for a long time. Very simple strategy. He kind of positions himself contra to a traditional PE buyer as a home for somebody, management team that doesn't want a lot of headaches, wants to kind of keep doing their thing, or an owner who really wants their legacy to be preserved. And I mean, just basically took that entire market position and started applying it But I'd always had this narrative in my head that one day I can do deals, right? One day I can go buy businesses and do all this stuff. And it really shift for me was really kind of the early emergence of the independent sponsor word and that, that whole ecosystem, kind of the mid, 2015, 2016, 17 timeframe. I started hearing about some of that stuff and seeing some more things around creative deal structures. And that was really what gave me the impetus to say, hey, I can actually do this stuff now. I don't need to go raise $100 million fund. I don't need to go sell XYZ business for X million dollars. I can approach these deals either as an independent sponsor or using creative structure or some combination of those things to be able to transact basically now. And so I started just hunting around for interesting deals, right? And I mean, using, for better or worse, a very similar approach to probably earlier Buffett, right? So really looking for value-oriented stuff, not always looking for things that have a really heavy asset base, but trying to use there's an old school book, it's out of print for a long time, called Margin of Safety by Seth Klarman. That's, the concept's pretty basic, right? But the idea is like, buy something below its value. Yeah. And if you do that with enough of a margin, it's really hard to screw it up.
Right.
And so that's basically, I stuck with these really basic ideas that I like can't dislodge from my head. Honestly, I sometimes almost wish I was more of a quote unquote growth investor, where it was like, I'm buying this thing at 20, I'm buying this thing at 10x revenue. We're going to scale it up and sell it at 20x revenue. Like, feel like I get, like, that seems really cool. But for me, I'm like, man, but I know if I buy this thing below its replacement value or below its asset value or whatever, that it's really hard to screw that up. And I know that's pretty certain. So I just gravitate more towards a more of a conservative approach to transactions, where it's like, hey, we're looking for value, we're looking for opportunities, and we're not afraid to be a little more hands-on for the deals that we look at too. I mean, I've done some special situation, I've done some sort of distress type stuff. That's not really where we want to be, all in, fully distressed type stuff. But we look for stuff that maybe either doesn't make sense for a big PE buyer, or they can't quite wrap their head around it, or the seller really doesn't want to just sell it to somebody who's going to, slash and burn and resell it again in 3 to 5 years. And I mean, I think the last little tidbit I'll throw here, the divestiture is a good example of, we're not opposed to selling a business in the right context, right? But our approach going in isn't, hey, we're going to do X, Y, Z and then resell this business. And I think that really fundamentally shifts our approach to say, we want to invest in long-term things that are going to help this business be really successful. The people, the processes, the market, all the different stakeholders. And so I think that shapes our approach.
Yeah. I mean, so, obviously in a classic PE model, they got a fund they raised, they promised investors certain returns within a limited period of time. Certainly as they want to show progress even before the fund's closing out, 3 or 5 years, whatever. And obviously as they get towards the end of the fund, which might be a decade or whatever it is, right? They got to get returns to be able to return people's capital, to give them a return. So hopefully they reinvest in the next one. Like that's, it's a very different model than you're describing. Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business, Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to corykupfer.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back to the show. I want to go back to a couple of things you said that some of our listeners who are very sophisticated or, some of us will understand fully. But we have such a broad range of listeners now, and some people are earlier. So you mentioned 2 key things. One is a independent sponsor and the other is creative deal, right? The structures on why you were able to sort of, get into the investing game, let's say earlier, maybe with less capital than having to have some huge exit. So I'd love you to delve into that a little bit more. What is an independent sponsor for those who don't, fully understand that? Can you just give a little input on that, and then we'll move over to the creative deal side.
Yeah, absolutely. So independent sponsors, is a fancy word for somebody who wants to buy a business that doesn't have a fund. Basically, they used to call them fundless sponsors, but I guess that didn't sound as sexy and cool. So now they call them independent sponsors. But it's basically just an individual investor, or sponsor is the fancy private equity term for a person with a deal, basically, who finds a deal and then they go and raise the money for that deal or a series of deals on a deal by deal basis, right? And there's pros and cons to doing that. The con is operationally, it's more of a pain in the butt. You have more execution risk. You have to go redo your fundraising more or less on each transaction. But the positive is you can structure each deal as an SPV with the specific nuances that transaction might require. You can use investors or a capital structure that's oriented more towards different goals than just a fund, which, as you said, has a life and maturity and redemption, all this kind of stuff. And, we try to structure it in a way where our investors, everybody's incentives are very aligned, where it's like, hey, if we're going to hold this thing for a really long time horizon, that should make sense for everyone. And if we're going to, if we end up selling it, that should make sense too. But the impetus shouldn't be, hey, we have to sell this thing in 3 years or 5 years or whatever. We're going to miss our IRR hurdle and we're not going to get a promote and all of that stuff. We've tried to structure the deals really intentionally so that's not the case. But the other term you'll hear a lot, and they're not exactly analogous, but I think there's a ton of commonalities, a lot of overlap on the Venn diagram, so to speak. Independent sponsor, another one you'll hear is searchers broadly. So you've got kind of funded searchers and unfunded searchers. I think or self-funded searchers, excuse me. So I think a self-funded searcher is pretty similar to an independent sponsor. Maybe the big difference being independent sponsors in many cases are more oriented towards not operating the business per se, but being a board member, whereas a self-funded searcher in most cases is looking to operate the company that they acquire.
Operator.
But this ecosystem has really matured dramatically in the last 5, 7, 10 years to where there's events and conferences. There's whole ecosystems of capital providers who focus on that world now, both on the searcher side and the independent sponsor side. And it's gotten much more transparent, I suppose, in terms of deal structure. And there's a lot more capital availability, private equity. There's whole PE firms whose strategy is basically just to find and fund independent sponsors. And it's made that world a lot more accessible. I think it's gotten more competitive as well. But I think it's made it a lot more accessible. And a lot of folks have realized, and especially in the searcher side of the coin, I fundamentally believe this too. It's like, hey, if you want to be an entrepreneur, I think personally, you're much better served to just go find a company to buy and operate than you are to go and try and start a new business. And you've heard the stats about the silver tsunami, depending on what you look at it. There's crazy numbers, and we can unpack them if you want, but crazy numbers about the amount of businesses that have to transact over the next 10 to 20 years. And for a thoughtful buyer or searcher to find a few gems in the fire hose of opportunity, I don't think is that tall of an order. And so to me, that's, my goal, our general approach. And, my goal isn't to build some big portfolio of assets that I'm managing. And that's another element. It's like the private equity business really is a business of getting assets under management, right? At the end of the day, and charging fees on those assets. I want to be in the business of owning the companies that we acquire, which is a little bit different. And so my approach isn't, hey, I want to go do 40 deals a year or 20 deals a year. I want to do one quality deal a year. That's really the benchmark that I'm looking for. And, and even then, if we don't do a deal, we're not hair on fire. We have to deploy this capital or whatever. We're really just waiting for the right opportunities. And when we see them, we want to get involved with them.
Yeah. And it's interesting because a lot of things we talk about come together in that, like, you said, one of the advantages of doing it on an SPV basis, right, is that you don't have that pressure to deploy capital, right? You're not sitting with a fund of money that investors are expecting you to do something with. So it allows for, in my mind, it allows for more deal discipline and patience, right? On the flip side, the challenge for some folks, especially who are newer, I'm sure you will pass this in large part, is raising capital in time for good deals, right? Obviously, once you got a track history, you got your investors, you got people, they know. So, that goes away once you have that because you can quickly access capital on a deal by deal basis. But early, it may be tougher for folks to timely raise capital, although, there is the argument, which I generally believe, that there's always capital available for any good deal. But the question is, can that particular person at that stage of their development or whatever have the access to find it, right?
And I think the key is good deal, right? Because I agree generally with that premise. I think there is capital available for good deals. The real question is it really a good deal or not? And a lot of times the market will help answer that for better or worse.
Well, that's right. And then it also ties in, obviously, that allows you, because you don't have this need to deploy capital in a sort of model on how you do the fund or whatever, and you can do it separately. That allows for more creative deal structures, right? You can do something different over here than you do over there. And it also allows, for more patient capital because you don't have a fund that sunsets at some point or whatever. So, a lot of things we talked about come together nicely in that. And it's interesting. You mentioned Buffett, you mentioned these influences on you, and you're right. I mean, the area, obviously, I've seen it as well. This area has developed, some more, but like the zeitgeist out there, right, has been so like, you are bucking the sort of normal trend of what people think PE people do, right? Even though there's,
for sure,
more of an ecosystem around it now, and it is becoming more mature for people that do it the way you're doing it. It is different, and it's certainly not what other people would think of if they say, if you have those two letters PE in any of the discussions, right?
Yep. And I mean, I think candidly, that's been a competitive advantage for us. And then if you look at Buffett, I think that's been a competitive advantage for him, right? I mean, we effectively just cloned his market position, which was, hey, we're an alternative to that trajectory. And some folks just want that trajectory, right? That's what they're looking for. And that's not, it's, hey, there's a misalignment there and that's fine. Go do that, right? But for folks who don't want that, or who are more thoughtful about maybe their legacy or their employees, et cetera, we actively position ourselves as the alternative to that.
Yeah.
And I think that helps us win deals. And I think it helps us, we have a very relationship oriented approach. We have a very, part of the reason having SPVs and having this approach, we're also able to really tailor deals that work with the seller and the goals they're trying to accomplish, right? And so that's a big piece of our puzzle, is to say, hey, even though, effectively I'm a private equity investor, we're not the typical private equity that you think of when you think of New York and, big fund and flipping the deals in 3, 5, 7 years, et cetera. We have a little bit of a different strategy, for better or worse, right? And I mean, there's pros and cons to both, but that's our market position.
Yeah, no, it's great. It's clearly a differentiator. All right. So what to oversimplify it. So I have a brand new AI startup that's going to be a unicorn and change the world, right? I'm not coming to you, right? So let's talk more specifically about who is coming to you, right? Are there particular industries, a particular, size of deals, types of entrepreneurs, whatever it is? What is the criteria? Like, we know what it's not now, right?
Yep. No unicorns.
Yeah. No, right. Yeah. I mean, for most folks, they were unicorns, but for you, like unicorn, okay, let me send you over there. So let's drill down a little more specifically on, the types of businesses, industries, entrepreneurs, management teams, whatever it is that you invest in.
Yeah. I mean, so if you look at our existing portfolio composition, and then I'll sort of tell you how that shapes our investment criteria. If you look at the existing composition, I have the IT business and the software company, though the way that I got into those businesses, I probably am not super competitive at current multiples in those sectors, right? So I'm in those spaces, but I'm not like actively buying software businesses currently. I would love to, but I'm morally opposed to paying 10x revenue or whatever the price is for a SaaS company these days.
On the SaaS side, and on the managed service side, that's a tough business.
I mean, those have just crept up massively. Yeah. So other than those two, if you look at really more recent acquisitions, I mean, we have a company that manufactures portable sinks, right? So kind of niche manufacturing. We have an industrial distribution business that does material handling and pallet rack and that kind of stuff. We have a staffing business that does light industrial staffing. And so, we typically orient more towards, though we're industry agnostic technically, but we orient more towards manufacturing, distribution, old economy type businesses, stuff that's simple, hopefully relatively predictable, but not trading at 20x revenue, right? And so our criteria is generally based in Nashville. So selfishly, I want to be somewhere that's east of the Rockies, more or less, excluding the Northeast generally.
Right.
I mean, if we see a great deal that's outside of that geographic constraint, we'll look at it. But generally eastern half of the US, Texas, Florida, Tennessee, anywhere that we can moderately get to from Nashville, it's not crazy far away. Size-wise, around 2 to 5 million of EBITDA. So we're trying to fish where it's big enough that it's interesting, but smaller than where a lot of the big PE folks really start to get active. Now, once you get up to like a couple $1 million of EBITDA, you're seeing some PE activity for sure. But it's definitely more Wild West than, 5+ of EBITDA, right? That's where it starts to get really, really routinized and competitive, and everything's, an auction and all this kind of stuff. So that's kind of geo size. Industry wise, we're flexible. That lends itself to certain industries just because we are relatively value oriented. So we're typically, trying to be in the like mid to low single digit EBITDA multiples, right? So we're not looking to pay 8x, 9x. I mean, for an incredible company that, some deal that we really believe in the thesis, maybe we would have that approach. But again, it's probably to my detriment, candidly, but I'm like stuck on this. I know value investing to me is empirically proven and it's like really validated. So I just try, I can't step outside of that mental cage, for better or worse.
Listen, know thyself, right? It's like, that's the biggest thing. If any of us try to do anything that doesn't align, with who we are, no matter how lucrative it seems for someone else or exciting it seems for someone else, it never works out. So I think it's super smart, on your part to stick with what you're called, and what you connect with. Okay. So, you make these investments in these, these companies and you look for the value. So I guess on two sides of this question, one, what are the factors that have you see value in something, right? When something's undervalued, and then what is it that you bring to the table? Because in addition to money, right? Because the people who are less educated about this space think money is the answer to stuff, and money is never the answer. Money is a important tool sometimes towards answers, right? But it is not, the answer. So what is it? What are the things that you generally look for in terms of where there's, a value gap? And then how do you help companies recognize that value?
So some of this is, maybe secret sauce is an overkill word for it, but some of this is part of our approach. But one of them, I'll give you one that's more sort of company characteristic financial, and then I'll give you one or two that are more operational. So company characteristic wise, I think one thing that intrigues us is something that has a little bit of hair that makes it maybe not a great fit for a current PE buyer. Let's say the business is, I'll give you two instances. One is maybe it's slightly over concentrated, but we think through either just organic growth or bolt-ons or whatever, we can deconcentrate it, right? So that gives us kind of an opportunity to say, hey, some buyers just won't even look at it, right? And we maybe have some leverage from a pricing standpoint to get it at a slightly better thing. And if we feel pretty comfortable that the risk is not even, there's some risk there, but if we underwrite it and feel really good about it and we think, hey, we can meaningfully diversify this risk away, that gives us an opportunity to play in that space, right? So that's one instance of how we would maybe think about value, quote unquote, just from a company characteristic example. Operationally, I think a lot of it is pretty basic, to be honest. Really what we're doing, we have a whole playbook and some resources and stuff, but we're just, in a lot of cases, implementing really standard best practices and professionalizing the finance and accounting function of the business, starting to think about professionalizing the sales and marketing. I'll tell you two or three stories just on the marketing side. Well, I'll give you one operational story and one or two marketing examples. So we bought a business a couple of years ago, 51-year-old company, distribution business, and the whole company operated on pen and paper, like carbon copy, pink and yellow sheets, right? So every day they would have orders stacking up and they would hand fill each of the sheets out, put them on so-and-so's desk, and they'd carry them back to the billing department and set them, and they would hand key each. And so it's like, you don't have to be a genius to be like, let's digitize that, right? That same company, their entire marketing budget was a TV commercial from 1992 that didn't feature any products that they even stocked any longer. Right. So again, we're like, let's spend that on digital marketing and SEO and something that's going to have a better return. So like a lot of it's pretty basic stuff, but I think it's totally normal and human nature for folks to grow complacent. If you're making, couple $100,000 a year or whatever,
doing well, right?
Why break it, right? Why make your life more complicated? And so we just see that a lot. Another business, not exactly analogous, but when we bought the company, I remember sitting down like a month after we closed this, sitting down with the president of the company, and they were spending $500 a month on Google ads, right? And I sat down, I was like, look, I want you to double our Google ad spend to $1,000 a month. And he looked at me, he's like, I don't know, like that's a big, like that feels pretty risky. Double it. Like, are you sure about that? Right. And so I was like, look, double it. Let's see what happens. Right. So he doubles it, goes really well, continues taking it up. Long story short, I think last month we spent like $25,000 on Google ads. Right. So, I mean, it's not crazy to say like, let's do some modern marketing stuff. I'm not like a marketing expert. Right. But we have, we find good resources that we plug in and try to do basic stuff. So the benefit of looking at some of these less loved older economy companies is the opportunities for improvement sometimes are really low-hanging fruit opportunities. You don't have to reinvent some crazy AI unicorn, whatever, to figure it out. It's like, let's just do, and our framework is, I have two, they're not exactly synonymous, but similar frameworks for how we think about improvement and growth. So one is a framework called more, better, new, which is basically, let's just do more of what's working first. Then let's think about making it better. And then only after that, let's think about doing new stuff. So we don't want to do any crazy new stuff if we can just do more of what's already working, right? So that in a lot of cases, it's just really obviously thinking about like one of our manufacturing business, about half the business sells to distributors and just in the US. And so we said, hey, are there any, like if we looked at Canada, is there a distributor that's analogous? It's obviously a smaller market, but a distributor that's analogous to our biggest distributor. And they were like, yeah, there's this company that's exactly like them. And it's like, okay, let's sell to them too. Right. So, I mean, it takes a little bit of effort and you have to get certified in Canada, do all this stuff, but like just do more of what's already working. So more, better, new is one of our growth frameworks. Another one is a phrase or philosophy that there's no silver bullets. There's only 100 golden BBs. Right. And so it's just all these little, hey, let's save 50 grand a year on freight, and we're going to save 50 grand a year on this, this thing. And then suddenly that starts to stack up and you're saving $300,000, $400,000, $500,000 on X, Y, and Z. And that's a 20-30% growth in EBITDA, right? Depending on the size of the company EBITDA. So just it's not rocket science. It really isn't. It's just being thoughtful and trying to do the obvious thing, which is, and this, I think most folks know this, it's not always easy to do the obvious thing, but we just try to figure out what's really obvious and do that stuff first.
It's fascinating because it just highlights further the contrast between, let's take my AI unicorn other side, kind of investment thing where, I mean, they got to compete with not only, like they got to be ahead of the cutting edge, right? On technology. Yep. Like, I'm going to state it a little bit of an extreme, but it's somewhat true. It's like some of these businesses, you're applying like 10-year-old stuff that other industries have from a decade ago that people have been doing forever just to, it's like, it's so far the opposite.
I don't want any of my competitors to listen to this interview because a lot of the stuff we're doing, like no one else in the space is even really doing it. And, it's like, hey, we're crushing people with some of these marketing strategies that are standard practices in e-commerce or like really competitive industries or whatever. Right. And everybody's this complacent 30-year-old company that don't have a website or they have some really bad, marketing strategy or whatever. And we're just gobbling up as much market share as we can because nobody's paying attention to it. So, I mean, that's not the case in every strategy in every vertical, but we've seen it in a lot of places where a lot of these industries are pretty sleepy and a lot of the growth strategies and approaches are really outdated.
Yeah. Yeah. What's the average size of your investment in these kinds of deals?
Right. So, I mean, I would say if you take average EBITDA of, let's say 3 and an average purchase multiple of 4.5, right? It's probably a $10 to $15 million transaction on average. High end, maybe low 20s, right? Low end, 5-6 million, something like that. So varies a little bit, but I think that's generally strike zone we try to be in.
Got it. And then the way you're doing is you're doing an SPV for each. You're raising capital from a group of investors, probably, in large part have done before, maybe some new ones, whatever it is, right?
Yep.
And then you guys, your company is, I don't know if you use the promoter word or sponsor word or whatever, but
yeah, that's right.
Yeah. Yeah. Okay.
That's exactly right. And yeah, I mean, we're typically raising from friends and family, high net worth individuals. But I'm always meeting folks, cultivating investor relationships, staying in touch with people. I think that's part of the game, quote unquote, of being an independent sponsor, right? Is just staying in front of capital relationships and I'm always looking to meet new investors. You never know, right? But yeah, we have kind of a stable of folks that have invested in a number of deals and generally know what their appetite is and what they like and that kind of stuff. And, for the first X amount of deals, I still do this honestly, but there's a lot of smiling and dialing, right? But
Sure.
I think, raising money is just the same as any sales activity, basically, right? It's just pipeline, have enough conversations, and eventually you'll cross the finish line.
And in terms of the investors in your deals, what's the investment range, minimums? Does it depend upon the deal?
Usually $100K minimum. And, if you structure the deal, you're buying something at 4 or 5 times EBITDA and you're levering it with some senior and you're putting some seller structure in there, you really don't end up with a massive, $2-3 million equity check, right? It's not like a huge lift. And so it's usually, candidly, we get better terms in most cases from high net worth investors than we get from going to a bigger, either a PE shop that backs independent sponsors or a family office that has really strong terms. And so we like the flexibility of working just with high net worth folks that give us better economics. And, we still drive strong returns for them.
Yeah, that's great. All right, we got to wrap up in a few minutes. But before I ask you my final 2 questions, is there any particular trends you see? There's so much out there that people talk about in terms of affecting deals, whether it's, cost of capital, whether it's, inflation, whether it's, there's certainly a lot of money still out there.
Yep.
Whether it's getting deployed and how it's getting deployed and how underwriting is and all that kind of stuff's a different question. But there is so much dry powder, out there still these days. But, any, just super quickly, and any big, things you're seeing in terms of trends or things to be aware of?
Nothing shocking. I think maybe some softening of the consumer, right? I think just on an operating level, I think a lot of folks are seeing that. I don't know. I don't have a well-informed view about whether we're headed to a recession or not, right? But I think thinking about, it seemed like consumers softened up a little bit. Broadly, spending consumers have kind of taken the brunt of the inflation and COVID savings have run out. And so to me, that's just something that I'm being thoughtful around is what does that mean, right? Yep. And how did that impact whether it's existing portfolio companies, things that we're underwriting, et cetera, and paying attention to it. But we're in a time that there's still a tremendous amount of uncertainty. Election year, the rate environment, the Fed, this is definitely uncharted waters for me. My entire career basically was rock bottom interest rates until about 2 years ago. So it's been an interesting experience.
Love it. So if people want to find out more about anything you have going on, what's the best place for them to do it?
Yeah, so I have a free newsletter where I talk about doing deals and buying businesses and M&A, and it's just at my website, mattbodnar.com, mattbodnar.com, and check it out if you want to hear more war stories and how I think about doing deals and all kinds of other stuff.
Great. And my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you and how does it impact your life and business?
I think similar to you, it's critically fundamental to my day-to-day existence, right? I'm similar to you in the sense that I struggle to work for somebody else just because I'm so independent. I want to do things my way. I want flexibility and freedom over my schedule. And to me, entrepreneurship, capitalism, et cetera, we could get into a whole sort of moral discussion around this, but I think it's a really, really powerful vehicle for achieving a lot of that stuff. And so to me, it's a cornerstone of the way I live my life and why I do what I do.
Love it. Matt Bodnar, thanks for being such a great guest on the DealQuest podcast.
Awesome. Corey, thank you so much for having me on. It's been a pleasure.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. The Deal Den is a place where entrepreneurs, high-level executives, and business leaders come together, support each other's growth and success, and share what's working best, as well as what challenges we are facing right now. You will get input not only from me, but from all of our members. We collaborate and serve each other. To join us, go to corykupfer.com/dealdeck. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.